Welcome to the Whitwam Wealth Real Estate Podcast. Today I'll be discussing funding your flip, creative financing for investors.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's podcast is Funding Your Flips, Creative Financing for Investors. If you haven't heard one of our episodes on creative financing, this is going to be really informative for you because this is an important topic for us as investors. I guess if you've got bucket loads of cash and you're buying everything with cash, you got millions of dollars worth of cash, this probably isn't a really important episode to you. But for the rest of the world and most investors that we work with, my coaching students, those who come through the program, those I meet at the investor meetings, hard money plays an important part. Creative finance, seller financing, lease options, all of these different things, partnerships, JVDs, all these things that are creative finance that play an important part. It's an avenue where you can stop buying retail houses with conventional money and leverage deep discounts. As an investor, I think that's very, very important. And today we'll cover 3 creative ways to fund your next flip. One's going to be hard money or private lenders. Those both work pretty closely the same. The next one will be joint ventures, and the third one will be seller financing. But let's get started. Hard money and private lenders. This has traditionally been the way that most investors who are using financing on flips will acquire a property. One of the reasons is it's taught by most real estate investing coaches. So it's been an avenue that's become very prominent for very good reasons, and we're going to talk about those. If you're an experienced investor, you're very familiar with this. I mean, you're very familiar with hard money. You probably got your hard money guys lined up. You know exactly how your programs work. But if not, you may want to become knowledgeable on this because this form of OPM or other people's money can elevate your real estate investing. These type of loans are designed to be short term. So these ones are ones that you're not going to keep for years and years, which is why this would not be a permanent financing for a buy and hold investment. It's going to be short term for a flip or a conversion property. Since the CFPB went into effect, that's the Consumer Financial Fraud deal that the federal government did, everything on this side of the house changed. Because 10 years ago, when I used to do hard money, I could do it in my personal name, I could do it in a business name, I could do it whatever, and everything was all of the same. But the criteria has changed a bit, and you're going to need to know about it going in. Otherwise, you'll be a little confused when you work with your first hard money guy. Because you're going to be likely required to purchase and take the loan in a business name. And generally, we do this in an LLC. The reason is because the qualifications now are outside of the consumer side of the lending. Disclosures are different. They don't have to fully qualify your income. If you go to buy a house, if you personally go to buy a house and you go to your lender, whether it's a mortgage banker, mortgage broker, or big box bank, it doesn't matter. You go in, they have a requirement through the Consumer Fraud Act that came out that they have to fully vet your ability to repay the loan, or that loan could get charged back to them, which means they literally have to pay it. You could sue them saying, hey, there's no way you should have ever loaned me the money. And so what they do is they say, okay, as hard money guys, we're not going and doing full background checks as a general rule. So what we're going to do is we're going to make you purchase this in a business. The rules are different. We don't have to go through all of the underwriting that you do in a traditional loan. So it avoids a whole lot of the consumer loan requirements. The loans are generally based upon the value of the asset, and that's what makes these loans really good. They're not basing it upon how good your financial statement is. They're not basing it upon the job that you have. They're basing it upon the value of the asset. The theory is hard money. They're going to loan you the money. If you don't pay it back, they want to be able to take the asset back, the real estate back. They want to be able to sell it and get their money back relatively quick. Some lenders may require credit scores, but there are many who do not. Most of them that require credit scores do what they call soft pulls, just to get an idea of your credit profile. There are those who pull hard credit. So if you're going to do business with them over and over, they want to make sure that you have a whatever it is, 640, 660, 700, 740, whatever their risk criteria profile says. But there's a lot of them out there that they really don't care what your credit is because, again, they're basing it upon the value of the property, the amount that they're going to, the loan to the value of the property. We call it an LTV. Generally, in hard money terms, we're talking about loan to purchase price. But if you're flipping, and getting out of it quickly, this can be a really good option because you don't need something fully underwritten. You don't really need the best interest rates that are out there. But hard money lenders vary their property qualifying criteria quite a bit. They're all over the board. There is no standard. You'll find anywhere from a 60% loan to purchase price to a 90% loan to purchase price. And then some hard money lenders will also go up to 100% of the repairs. So there's a lot of variance out here. The amount of money that you have to put down, what they like to call skin in the game, is how much are you invested into this property. That makes it less likely that you're going to walk away from the deal. And then if you do walk away from the deal, it creates, again, a larger value disparity so they can sell this property pretty quickly. Some states, it's a little bit more of a process to go through foreclosure than others. I live in a state that it's pretty easy to foreclose, 90-day notice, 90 days late, 90-day notice, and then foreclosure sale. So it's pretty easy here, but there's a lot of states where the process can be pretty lengthy, and so they want to make sure that you got enough skin in the game and they've got enough margin on the other end so that they're not going to lose money. But again, some of them will loan you not only the money to buy the house, but they'll loan you up to 100% of the repairs. So you're bringing in, we'll say 10 or 20%, and then you were going to bring in another 10 or 20% to do repairs in the home. You may be able to finance all that too with a hard money or private money lender. So here are some of the benefits to using hard money. First, fast approvals. Most hard money lenders can get your deals approved within a couple days. I have a hard money lender that I work with. He's more transactional, but they basically give me an approval within hours. I send them the property address, I send them the ARVs, send them what I'm paying for it. And they're actually a little bit different there because they're transactional. They're a shorter period, higher interest rates. We've had deals we've done with them where they financed 100% of the deal, no questions asked. It's changed a little bit in the last 2.5 years. I know that they're not doing those loans anymore just simply because the market shifted. Their level of foreclosures went way up when interest rates started going up at the last part or mid-2022. So, but they're out there. You can find private money and hard money guys willing to take risks, and their risk to them is if they don't mind acquiring properties. If they have to foreclose, a lot of these guys will take these in. They'll add them to their own portfolio. The next thing is it's easier to qualify this asset-based rather than credit-based because it's all about the property. It's about, are you buying the property right? Are you putting enough money down into it? It's not credit-based. It's not based upon whether you paid your Sears bill on time, whether you paid Citibank on time, whether you paid your doctor on time. They generally don't care about any of that. All they're interested is does the asset back the loan sufficiently that if you do fault, they can get their money back. It's a whole lot faster. It's a whole lot easier. It takes away a lot of the criteria for it. So, but for every benefit, there's, kind of the alternative. There's some disadvantages to it too. And we're going to talk about those in a second. The other benefit is flexible terms. It's great when you need quick access to funds. I mean, we've gotten deals that we've closed in just a few days. Call up a hard money guy. He goes, yeah, we'll approve the deal. Okay, here's all the information. We get it over to Title. Title gets them the information, and all of a sudden they're wiring the money to Title, and we got a quick close. For somebody who's facing an emergency, This is a great opportunity for you to come in and be a hero, which means that you're going to get a little bit better deal because you're taking more risk. You don't have near the time to fully vet maybe the house itself, and so you're building a little bit more margin into it. We picked up some houses on much better terms because we could close quickly. Okay, so here's some of the drawbacks, right? I just talked a little bit about, or I touched on it, higher interest rates. Typically, hard money is going to be somewhere between 9 and 18%. And you can see that it varies. It's going to vary with the marketplace. I've been quoted recently, 8.99%. And it's pretty easy also to find guys who are 18%. 18% guys generally don't have as many other criteria as some of the 8.99. 8.99, they want, soft credit pulls. They want bank statements. They want all this other information because they're doing more of a qualification, even though they're basing it upon the asset. But the interest rates can be much higher than market rates. I mean, the market rates right now aren't real cheap on the commercial side. They're 8, 9, 10%. So for buying an investment property right now, they're kind of in the 8, 9, 10%. Another drawback, if you would count this as that, is you got shorter repayment windows, usually 6 to 12 months. Most hard money guys have built in what they call extension periods. So if you have a 6-month hard money loan, you can extend it to 12. If you have a 12-month one, a lot of times you can extend it to 18 or 24, but you pay for that. There's generally a penalty associated with it. You've got a fee for reprocessing the loan. But shorter repayment windows, if you were doing a traditional finance loan and fully underwritten, you'd still be 15, 20, or 30 years. So this is made to be much shorter. The intention is you're going to buy this property, you're going to rehab it, you're going to get it at the market competitively priced, it's going to get sold, and you're going to be out of the deal. Another drawback would be that some hard money loans have fees and other expenses. So you have to remember if you're going to deal with a hard money guy that goes, okay, hey, we've got 8.99% interest on our hard money loan, but we got 4% underwriting and processing fee. You've got to build all of that into your total holding costs. And I take these numbers. So let's just say somebody has a 10% rate on the loan that I'm going to have for 6 months, and they're charging me 2 points. 2% of the total amount of money that I'm going to borrow. I'm going to have that money for 6 months. I've got to take the 10%. Plus now, since it's 6 months, I'm going to take 4%. The effectual interest rate is around 14% for that money. May actually be higher when you calculate out the APR, but I just did this in my head. So that money now is costing me 14%. So, 10% with points may be more expensive than 12% without points. So you got to look into all those and then build all these into your holding costs so that you know what you're dealing with. If you're new to hard money, my advice is shop around. You can do an internet search, turn up several hard money and private lenders. I know that our coaching students who come through here, depending on where you're at in the country, we provide you with some hard money connections from people that we've dealt with before. But compare rates. Compare leverage requirements, compare fees, and also rehab financing options. I always want to make sure that you recommend that if you're new at this, that you have your hard money lined up before negotiating your first deal. There's nothing like negotiating your first deal. You're excited about it, then you go out looking for hard money, and you find out that it's much different than what you thought you could get. And now you're forced or squeezed into a loan, and then it makes the numbers on your deal not work. So go out, find this, get it set up first. Once you've done a couple of these, it gets easier because you have a history then to lean on. All right, our second point I want to talk about is called joint venture. So we've got our hard money private lenders. The next one we can do is a joint venture, which is a partnership agreement. It can be with a seller, it can be with another investor, and it can even be with a buyer. These deals can be built in many, many different ways. So there is no set form to how this can be done. So let's talk about doing one with a seller. So if I came to a seller and said, hey, Mr. Seller, you've got this property. It's in horrible shape. But what I'll do is I'll come in and I'll partner with you on this deal. I'll do all of the rehab, I'll list the property, and I'll get it sold. And for that, I don't make any payments on the property. Or we've had a few of these where people are going into default. We catch up their payments and we start making the payments every month. So, or you can do it where the seller continues to make the payments. You're providing all of the rehab. So we come in, we put whatever, $50,000, $75,000, $100,000 into the house. And then when we get to the end of it, Mr. Seller, we're going to sell the house and we will split the profits. Now, many times what we do is we create a base. So if somebody's in default, they're looking for a base. Let's just say they owe $200,000 to their lender, house worth $500,000. Maybe we guarantee them $300,000 for their house, but they're going to continue to make the payments, or even if we take the payments, right? So now they know they've got $100,000 in profit. We come in, we do all the work, we spend $50,000, $60,000, we sell it for $500,000. Let's just say there's $100,000 profit over the $300,000. Well, we may split that with them a myriad of ways. We may do a 50-50 split, which if I'm guaranteeing them a $100,000 profit, I'm probably not going to do. If I'm not guaranteeing them any profit on the deal at all, then I may be more inclined to do 50-50. But I may do a 60-40, a 75-25, an 80-20, where they're getting a bonus on the back end, or even a 90-10. If I'm guaranteeing them $100,000, I may say, but because you're carrying this thing, or you're letting us make the payments for you and carry this thing, I'm going to give you a 10% bonus on whatever we sell the property for. So you can joint venture with a seller in a bunch of different ways. Lean on their financing, or if it's paid off, obviously let them be the bank, and joint venture together with them so they get a bonus at the end of the deal. We talk a lot about joint ventures, and we do talk about hard money stuff, but we talk a lot about joint ventures, or I guess more about joint ventures in the book, No Money Down, that I wrote. In that book, we talk about many of these different ways that you can buy houses with no money down. Joint ventures are a good way to defer your investment in the property. The other way we can do this is we can do this with another investor. So we find the property, we're going to provide the rehab, the other investor puts up any money to bring the mortgage current, or any down payment that the seller's requiring. Or if we have to turn our joint venture into a hard money transaction, our joint venture partner provides the down payment for the hard money that's coming in. And then when we get to the end of the deal, we split whatever those terms are, 50-50, 60-40. But we utilize other people's money. We utilize the other investor. They may not have skills to do the rehab and fix up and marketing and sales of the property, or they may just not want to do that. That may not be their thing. They've got money and they want to be the cash investor, and they want to make a profit on flipping houses, but they don't want to do the acquisition. They don't want to do the rehab. They don't want to do the disposition of the property. And so you can do that. You can joint venture with them and create a joint venture agreement and do that. And I do want to say this, always make sure that you're protecting yourself. We'll talk a little bit more about that. The last one I want to do that really surprises people, you can actually do this with a buyer. If you have a buyer that wants certain things in a house, sometimes finding a house that needs a full remodel, a full gut and remodel is perfect, because they can pick out the flooring, they can pick out the counters, they can pick out the cabinets, they can pick out the paint color, the trim, all of that. And so what you do is you utilize your buyer's money in either to make your hard money down payment, or to satisfy anything if you're doing this as a seller financing. So now you've got a buyer JV on this thing, and you've got maybe a seller financing on this. But either way, or even a joint venture with the seller, so you can have a multiple angle deal on here. The seller provides you the money, you provide the rehab. I mean, if you're real creative, get the buyer to provide all the money for your rehab as you go. So now you're really not in this thing. Your job was just to find the property, negotiate the deal. And then when you get to the end of it, have a predetermined markup on the price of the house. So if you're buying the house for $200,000, you're putting $100,000 in it. Maybe there's the buyer's going to pay you $50,000 at the end for managing this joint venture and doing this project. But again, like I was saying, you've got to protect yourself. You have to be using a joint venture agreement of some kind. And my recommendation is, even if you go out on the internet and just try to find one to use, do not use it until you have paid an attorney to review it. I paid an attorney to draw mine up, and it's worth every penny that I paid the attorney. If you're going to do joint venture deals and more than one joint venture deal, the cool thing is you can use this joint venture agreement over and over and over and over again. And the joint venture thing, it's so good because it spells everything out. It covers everything, covers all the what ifs. Okay, what if the buyer does this? What if the seller does that? What if your joint venture partner does that? What if I do this? What's going to happen if we get to the end of this and somebody doesn't want to sell, somebody doesn't want to sign? All of that is built into the joint venture agreement and tells who's responsible for what, how the profits are split, how the losses are absorbed, all of that stuff. What happens if somebody wants out early? So, that's something that I would say is very important. Get a good joint venture agreement. If borrowing feels too risky for you, a joint venture partnership can help disperse the risk. This can help bring less risk to your transaction and make it a very good opportunity. Again, you can get our book, No Money Down, on our website. Just go out to witwamwealth.com. You can find the book out there. Feel free to download it and read through it. It's got some great points on not only joint venture, but some of these other topics that we're talking about. Okay, the next one I want to talk about is seller financing. Seller financing is just what it sounds like. The seller is financing the deal, or the seller is becoming the bank. Instead of getting a loan from a lender, you negotiate terms directly with the seller. Often, you can negotiate the deal with little or no money down. So I talk a little bit about this in my book. No money down, because there are opportunities here to acquire a property fully using other people's money. And I love it if we're not having to bring huge down payments, because we can use that for other aspects of the transaction. But I do want to be clear. I am not talking about subject to. Subject to has become really big. It is another method. We talk a little bit about it in the book. I'm not going to cover that subject today. But subject to is the process of not getting the seller to finance it, but getting the seller's lender to finance it without the seller's lender knowing about it, without qualifying with that other seller. So I'm not going to talk about that today. Again, it's in the book, No Money Down. But I want to talk about seller financing for this third one. This is where the seller or the owner of the property owns a property free and clear, but doesn't need the cash right away. They can benefit from the cash flow and the interest. That's more important to them. They may need the cash flow on a temporary basis. They may need to avoid capital gains in the immediate. Maybe they got a big capital gains event in this year, or a big tax event in this year, and they don't want to add a capital gain to that mess and lose a good portion of their profit from this. So a seller financing deal can defer that capital gains out. The seller gets monthly payments while you renovate the property, and then gets cashed out when you sell it. And you may have to build in a predetermined sale date. They may say, yeah, I'll do this, but we cannot sell until January 1st of the following year. Sometimes it makes sense for the seller and you as the investor, to turn these things into buy and hold transactions. So maybe the seller goes, well, yeah, I can do this. I'll seller finance it, but I can't have a payoff for 3 years. He may have some estate issue or whatever. So you go, well, no problem. I'm going to go ahead and refinance it. I'm going to put a tenant into this property. I'm going to start to cash flow this. The seller gets extended interest and cash flow, and you get the same thing. You get to collect interest on the money that you invested at a much higher rate than you will in the marketplace. You now have a rental property that's providing passive income over these predefined number of years. And then you build in a payoff date or a balloon date when the whole mortgage becomes due. And then you refinance it and keep it as a rental, or you kick the renters out, you go into a refresh on it, get it on the market, and get it sold. All right, so here are some of the benefits. There's no credit checks or bank approvals needed for seller financing. The seller makes all the determinations themselves. You don't have to go through the full underwriting process at all. Flexible terms. You negotiate the interest, you negotiate the payments, and you negotiate when balloons are due, what the balloon payment will be. Will there be multiple balloon payments along before the final payment? This is great for properties that don't qualify for traditional financing. We have some investors that work in the manufactured home market. If the houses are, I think it's now before 1980, it's hard to find financing on those. So those ones are perfect for seller financing. Some properties that have severe deferred maintenance, they're not going to qualify for any traditional financing. You'd probably do it for hard money, but it would be much better if you could get seller financing, then you don't have to go to a third party. So these ones here are great for ones that don't qualify for traditional financing. A lot of times those are easier to negotiate too, because you can, the seller knows, the owner knows that he's not going to be able to put this thing on the multiple listing system and get somebody to come in with FHA financing. The property's not going to qualify it. Just like with a JV agreement, you want to have a solid contract. It's worth paying an attorney for a good one, especially if you're going to use it more than one time. Or you can build the cost of the legal fees. We did this with our first JV agreement years and years and years ago. We had a perfect JV opportunity, and the owners, which were the estate, were desperate on this one. And we just said, hey, look, we're going to do this, but you're going to pay so much in attorney fees for the agreement to protect both of us. We had our attorney write up the contract, and we deferred the payment over to the client. So you can build those into the deal. So the contract doesn't necessarily have to cost you. It may cost somebody, but get an attorney to write a good one. And you can use them over and over again. If you invest, even if you have to pay for it yourself, you can spread the cost over each of your deals as you do more and more of these transactions. Well, there you have it. 3 creative ways to fund your next flip: hard money, joint venture, or seller financing. You don't always need deep pockets. What you really need mostly is creativity. And that's it for this episode. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Check out our previous real estate investing topics. And I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.